Have you really considered what could go wrong with index funds? Everyone's convinced these funds are the silver bullet to retiring early. Video after video, they talk about this or that index fund and how you can rocket to early retirement if you strap in. I don't know about you guys, but these rockets have had directional challenges in 2022, and you may have paused and thought the same thing as I have. Can I really trust these funds to help me retire in say 5 to 10 years? Is this really gonna work? Like, everyone's brilliant answer to every investment goal these days seems to be to buy index funds. What should you invest in your 401k or IRA? Index funds. What should you invest in for your kid's college fund? Index funds. What should you invest in for your health savings account? You get what I mean, right? It's gone so over the top that people on Reddit are asking if they should dump their down payment on a home into an index fund. And in case you're asking this yourself, the long answer is no. Now, don't get me wrong, index funds like those tracking the S&P 500 are great for building wealth if you plan to stay invested for a really long time, as in decades of time. But if your goal is specifically to retire early, chances are you don't intend to invest for 40 or 30 or even 20 years. You're most likely considering a time horizon of 10 years or less before you start living off your investments. And a time frame that short for index funds is in danger of underperforming and delaying your life of financial freedom. These are the annual S&P 500 returns since 1928, and some years have had terrible returns back to back to back. If we average all these annual returns into a rolling 10-year period, this is what we get. So if you attempted to retire early in 2010 with 10 years of index investing immediately prior to that, it would have been a train wreck. The same is true for 2009, 2008, 1978, 1977, and on and on. Here's another way to look at it. When you analyze the 83 distinct 10-year rolling periods since 1928, 3 out of 10 of them had negative returns, and 4 out of 10 of them had returns less than 5%. That's less than half the average historic return of 10%, and this is before factoring in inflation. So the next time you read those financial blogs and watch those YouTubers and interviews on CNBC about how somebody retired early with some $1 million portfolio, even if you copied everything they did by saving a buttload of your income, lived frugally, and threw money into index funds, there's a high probability you will not get results as good as they did if you started recently. Those people were fortunate to have invested during one of the longest bull markets in US history, and the chances of it repeating within the next 10 years is slim for several reasons. One of the most fundamental metrics to estimate the future returns of a broad market index fund is the PE ratio. This one here is the Shiller PE ratio, arguably the most popular measure of stock market valuation, and it's safe to say after all that's happened this year, the market is still overvalued at 28. The historic average is 17, this line right here, and right now it's coming off its third highest peak ever since the dot-com bubble here and the Great Depression here. The stock market in the years following these previous record peaks had very underwhelming returns. And you can see that back in this chart. The red bars right here and here. And these aren't just one-off events. When you look at the data of the relationship between the PE ratio and the real returns in the subsequent 15 years across the US and many other stock markets, the higher the PE ratio, the lower the returns. So with a ratio of 28, which would be right here, you would expect about a 3% return, give or take. Not exactly the rate you would want to retire in less than 10 years. But that's not all. There is broad consensus across most of the major banks, financial institutions, and big names in finance that the next decade is going to have lower average stock market returns. Recently, Stanley Druckenmiller, one of the most legendary hedge fund managers around, made headlines predicting we are heading into a lost decade for stocks. Morningstar Investment Management is predicting a 5.8% 10-year nominal return for US stocks. So the real return, which excludes inflation, will be under that. Charles Schwab is forecasting a 6.4% nominal return, but with a 2.5% inflation forecast, they're actually predicting a 3.9% real return. And then there's this problem. The US population as a whole is getting older. And as older retired people outnumber younger working people, it's going to reduce real economic growth, which translates into lower stock market returns. Millions of baby boomers have already left the labor force, and according to the US Census, this trend will continue through 2034 and beyond. It's no coincidence that when you look at the ratio of the dependent population to the working population every decade since 1940, the stock market generally produced higher returns in these decades when the ratio of youth and elderly was lowest compared to the working age population. inflation. Now with the trend reversing since 2020, it's one less factor in favor of higher returns. So if index funds fail to grow your portfolio fast enough and you can't retire early, are you just going to settle for working longer while waiting on the stock market to get its act together? Isn't it worth considering other options where you are more in control of your financial destiny than to depend on the whims of the economy and the markets? Let's set aside index funds for a moment and remind ourselves what truly matters to be able to retire early. At the end of the day, it's not really about the value of your investment portfolio or even the growth of your investments. It's not really about some safe withdrawal rate off that investment either. Whether you think 4% is a safe rate or 3% or 5%, whatever. The bottom line is it's always been about income. A fat portfolio may give you the thrills, but income pays the bills. If you need $40,000 every year to retire and it was guaranteed safe, reliable, and consistent, it wouldn't matter to you if it came from a portfolio worth $100 or $100 million. So instead of waiting around for index funds to grow your portfolio to then withdraw the income you need, consider focusing a portion of your investments directly towards generating that kind of income right now. And the most popular ways to do this are through dividends and even some bonds. But I get it, prioritizing income over growth may feel counterintuitive to some of you because we've been subtly conditioned to believe that maximizing total returns through growth investing is the only thing that matters. This shouldn't come as a surprise since for decades, the investment management industry has had this twisted incentive where their profits grow fatter when your investments grow under their management because they get paid based on the size of your portfolio. And so they rather you not draw any income from your portfolio as long as possible based on the rationale that you should maximize total returns and that is supposedly in your best interest. But for most of history, this isn't how people invested. In 1612, the Dutch East India Company was the first publicly traded corporation to pay out a regular dividend income. The average dividend yield over its 80-year run was just under 20%. The reason it started paying out this income was because the shareholders lost trust in management to properly value their shares. Receiving income from your investments was a norm for centuries until the 1920s when Wall Street realized that they could profit more by keeping your money tied up with them. And so after decades of this practice, everyone just assumes investing for growth and maximizing total returns is always best all the time. But if you want to retire early, the risks may be too high. So investing for income could be the safer strategy to, at the very least, hedge against the poor performance of index funds. Income investing can take many forms, but dividend stocks and ETFs are some of the most popular ways. By investing in quality dividend-paying assets, you can easily build up a reliable stream of dividend income that's immune to the ups and downs of the broader stock market. Now, if you're concerned how anyone could possibly live off dividends from quality stocks like Coca-Cola that yields only 3%, the world of dividend investing today has much better offerings than this. In this video here, I cover how you can safely live off dividends faster than you thought possible by debunking 3 common myths about dividends. I talk about investments that pay double-digit yields and will never fail to pay out a dividend every month. But most importantly, it may be the perfect investment to help you retire early. So check it out, and thanks for watching.